I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White and my guest today is Andrew Lockhart, Managing Partner of Metrics Credit Partners. Andrew, welcome.
Thanks, Peter. Thanks for having me.
Could we explain the concept of private debt and the role it plays in the whole non-banking institution situation?
Yeah, private debt is really a reference to a direct loan from a lender to a company. So we're talking about performing loans to performing companies. And it's referenced as a private debt because unlike public market assets, say bonds or shares, it's not something that you can buy and sell over an exchange. And so as a lender, you obviously need to originate the transaction directly with the company, structure the terms and conditions and provide that financing. In the Australian market, loans are not traded. You generally hold the loan through to the maturity date. And so if you're lending to a company for say 3 years or 5 years, you're looking to provide financing. So it's a core provision of a loan to support the activities of a company, but they're confidential, and the terms, conditions and the pricing associated with those loans that are made to companies is retained as confidential information between a lender and its borrower.
The terminology private debt and as private credit, are they interchangeable?
I think so. I would say, private debt, private credit. Credit perhaps means for some people more opportunistic or higher yielding opportunities. Whereas private debt, I guess, gives the concept that it is a core component.
But the terms are interchangeable.
Yeah, I believe so.
Yeah. There's a common perception that if you've got to go to a non-bank lender to borrow, that you're not investment grade. Is that a fair comment, and how do you deal with that perception in your business?
The point I would make is if you actually think about the Australian economy, most Australian companies are unrated. Most Australian companies aren't able to access financing, say, through a bond market. The Australian bond market is not very diversified in terms of being able to finance the Australian economy. And so what's actually happens is that most Australian companies are actually heavily reliant on banks for funding. And as a result of some changes to the way in which the banks are required to hold capital against their assets that really came into effect at the time of the GFC, it's meant that the banks are effectively finding it difficult to finance all of those companies' requirements. So importantly, what's occurring is those companies are needing to find alternative sources of debt financing away from the banks.
And what sort of companies are these, those that are looking for non-bank finance? Is it possible to categorise, or is it a very, very broad group?
It's lending to companies that are large, diversified businesses in their own right. And so we would talk about our lending being to corporate and institutional grade borrowers. And so the areas of our activity really cover loans to public and private corporates. So we do lend to ASX listed companies. We also are active in commercial real estate financing, project and infrastructure facilities, and also acquisition finance. So they're companies that are operating brands, services, businesses that employ numerous amounts of people, generating solid earnings and generating returns for their shareholders. And we work with and also compete against the banks to provide financing to these companies. It's not as though, we are not a lender of last resort. So when we provide financing to a company, we're not providing financing to a company that couldn't obtain finance elsewhere.
In an emergency situation.
Yeah. What you tend to find is that most companies that are large scale, a lender wants to restrict or limit the amount of risk that they have to any one individual borrower. And so what that results in is a number of lenders coming together to provide financing to that company. And so as a result of that, that's why we would say we work with banks or other non-bank lenders to provide financing for the whole. So if you think about a borrower looking to borrow, say, $500 million, it might be that each lender might be comfortable providing a loan of, say, up to $100 million. So you then have 5 lenders coming together to provide the financing to that company. So it's not as though it's exclusive only to the banks. Certainly we think we've created an opportunity for our investors to gain access to an asset class that we believe is attractive, and we do compete with the banks to provide financing to those companies.
The concept that all these companies who are borrowing from you are potentially below investment grade because they didn't get the money from the banks. Is that a fair assumption, or is that incorrect?
It's incorrect. Most Australian companies would be sub-investment grade borrowers. And so what you tend to find is that the lender subjects the company to tighter terms and conditions and controls to mitigate the risk associated with lending to those companies. So sub-investment grade might be as a result of the size or the diversity of the company or the earnings growth. There can be a range of things. It could be that the company has more leverage. It can be a range of areas that drive the determination as to whether or not it's an investment grade borrower or a sub-investment grade borrower. But the vast bulk of borrowers in the Australian market would be sub-investment grade.
The low cost of capital, has that had an impact on your business in terms of, it seems to me it's more competitive now. Has that made it more difficult for you operating your business, the low cost of capital?
I think what's occurred as a result of the pandemic has been the Reserve Bank provided additional liquidity for the banks, and as a result of that, the market was awash with liquidity and the banks were able to provide financing to companies at a time when emergency funding was really required. Now what's occurred is that the banks have had that facility or the liquidity facility at the Reserve Bank removed. They are now looking to access financing to finance their own activities, so they'll go off into wholesale funding markets offshore. As a result of that, we expect the bank's cost of funding to increase, and therefore the margins that would be applied to borrowers would start to increase as a result of those two changes in the market. But certainly as a result of our activities, what we've tried to do is to be relevant to the banks and to borrowers across the market. And so you have to have raised capital at a range of different price points. So for instance, if you're lending to a sub-investment or an investment grade borrower, you can hardly charge them high margins. You wouldn't be competitive. And so you need to have a competitive cost of capital, but the real setters of that cost of financing are the banks in this market.
Private lending, the whole sector, has been embraced by institutional markets for quite some time, but very much less so for private borrowers and for the advisory market. Where is that situation heading? Is it easier to explain your offering to investment advisors these days? What's happening in that space?
I think we've been really pleased that we were probably one of the first groups to be able to raise capital from financial advised clients. And so what we established was a vehicle that provided investors with a means to determine what is the risk that they're prepared to accept, what is the return objective of the vehicle, and then how do they gain control or liquidity to their funds if they want to redeem. And so what we were the first to do was to structure one vehicle that was listed on the Australian Stock Exchange, which is the Metrics Master Income Trust. We followed that on with the Metrics Income Opportunities Trust. So as a result of those two funds, we have over $2 billion raised from consumer retail clients, financial advised clients or self-managed super fund clients that has been used as a source of capital that allows us to lend to companies. We've followed that on with dedicated retail offer funds that are not listed on the stock exchange, but we've tried to broaden our investor base. We believe that it's a great opportunity for investors to gain direct exposure. It's an alternative way to invest other than being invested in traditional fixed income. So I would say that the asset class that we provide investors with is very attractive because it provides for stability of capital. There are a lot of protections, security that are involved associated with lending money, and it delivers an attractive alternative source of income that's not correlated with equities or franked dividends or the like.
If and when interest rates go back up, and it's already started, will it be a harder sell to the average mum and dad investor to go into private debt, private credit, or do you think there has been a sea change and that this market is going to be a growth market continually?
Unfortunately, for investors that have been invested into traditional fixed income, over the last several quarters, they've experienced negative returns. As market volatility has risen and impacted as interest rates rise, that's impacted the returns of their portfolios. In a portfolio of private loan assets managed by Metrics, the majority of the loan assets are floating rate. So therefore, as interest rates rise, the total income and return to an investor increases. So it's actually delivering what investors are looking for in that interest rates rise, the flow-through impact is almost immediate in terms of...
Versus a TD, which is a fixed rate.
Well, if you think about our listed fund as an example. Investors can generate an attractive return. That fund seeks to deliver investors a minimum return of 3.25% over the RBA cash rate, net of fees and cost. We've exceeded that since listing the fund back in October of 17, but the attraction is that an investor can buy and sell those units on the stock exchange on a daily basis. So effectively generating a much higher return for a liquid
with
daily
perfect
liquidity.
liquidity almost.
That's right.
It would seem a no-brainer. Would you agree?
I like the fund.
Yeah. Finally, when you're looking at assessing borrowers, how important is origination and due diligence in that whole process?
Extremely important, Peter. From our perspective, our value that we bring to our investors is the capacity to originate transaction opportunities directly with borrowers. So that requires you to have extensive networks and relationships with banks, with borrowers directly, corporate advisors and others. And you need to have a very strong understanding of what are the drivers of cash flow. What's the purpose that the company is requiring funding? And then what are the ways in which we as a lender can be confident that the company is going to generate sufficient cash flows to service and repay the debt? And then if circumstances were to deteriorate, we want to make sure that we can get our money back under adverse circumstances. So the need to originate transaction opportunities gives investors access to the opportunity, and it drives fee income that can be charged to the company. So when you provide a loan, we'll charge an upfront fee. That becomes a source of income for our investors. But the need to do due diligence and understand the risks associated with lending to those companies is vitally important, because credit risk is probably the largest risk that an investor would be exposed to. So the need to protect and preserve investor capital comes from extensive due diligence, understanding the company, ensuring that you've structured appropriate terms and conditions, imposed covenants, controls, taken security designed to mitigate risk of loss. And so the two aspects, one drives income, the other is very important for protection of investor capital. And so the combination of the two is what we believe delivers an attractive investment proposition to our clients.
Well, speaking of that, what's your default rate like in loans?
So it's actually very low. If you look back at the data that the four domestic major banks produce, they go back to March of 2019, and they reference the maximum losses experienced in the corporate lending market occurred in March of 2009 at the rate of 0.67 of 1%, and that was the actual net write-off. Our experience, we've been operating our various funds now since June of 13. We've delivered consistent month in, month out income for our investors with stable capital now over almost 9 years, without loss, either operational or credit risk impacting our investors' returns. So I think that's a very unique track record that we can clearly demonstrate to investors. Regardless of the volatility in other asset classes, we've demonstrated the stability of capital that's available and the attractive source of income. But it's important, I believe we've got a very strong, credible team that understands the risks associated with providing financing to companies. And as a result of that, we've got a strong skill set to be able to lend on appropriate terms and conditions to manage the risk.
I think your book is about 80-20 institutional money versus mum and dad money or private investor money. Do you see that that ratio remaining the same, or is there going to be more growth in the private or individual market investing in your products?
I think there'll be material growth, particularly out of self-managed super fund investors. If you actually look at the self-managed super fund sector, there's a large component of cash that sits in a bank account.
Not working very hard.
Not working very hard. And so what we're effectively offering investors is a means to, you're moving along the credit risk spectrum. You are taking risk. It's not a cash deposit. But I think the return that can be picked up justifies that potential risk. And so, for most people in the Australian economy, the economy or the demographic is ageing. And so people are moving from that position of needing to be invested in growth assets and looking at ways in which they can generate an acceptable income on their retirement savings that is going to be not subject to material bouts of volatility and the risk of potential drawdown. If you think about it, you've retired. You don't want to have a lot of money tied up in assets that are risky and can go up and down in value, or you're exposed to potential risk of loss. So capital preservation and generating an acceptable income for which you want to live on is important. And obviously what we've experienced over the last several years as interest rates have declined, that's become very difficult for investors. And so investors have needed to think about what are the alternative ways I can gain protection of my capital but generate an alternative source of income. And so I think it really does meet the criteria of what investors are looking for, particularly for investors that are looking for how do you manage for your defensive part of your portfolio. The defensive part of your portfolio in the Australian market was quite limited. It was government bonds, corporate bonds, the odd hybrid here or there, some term deposits. Really what we've given people is an opportunity to invest in a well-diversified, well-managed portfolio that's generating an attractive source of income. So when we've set up our funds, what we've really tried to do is to say to investors, well, you determine what your risk profile is. As a lender, we can lend to investment grade borrowers and the returns will be reflective of the lower risk. Equally, we can provide financing to a higher risk transaction, but the returns will be more of an equity-like income. So the asset class is actually very broad. You can really generate...
Do you think that's realised by the advisor community?
No, I don't.
What is a typical conversation with an advisor when you're presenting your case?
I think we've had to explain and help the market become a little bit educated and informed. I think, unfortunately, over many years, the Australian market has not had a terribly good experience with a lot of credit funds or assets. You need to think back to...
The pyramids and the others. They've given debt a bad name.
They have. And unfortunately, what we've been exposed to is people that have been invested in mortgage funds that locked up, that froze liquidity, or they were invested in a particular, credit fund that was doing derivatives or complex transactions, or the manager wasn't focused on what are the cash flows.
Spiv standing behind it.
Yes, unfortunately. And so what we've tried to do is differentiate our business and our performance. And now we go back over 9 years where I think we've demonstrated that. We believe that a strong corporate governance, a strong culture that is focused on risk management and delivering for investors is actually what we've been seeking to provide to our clients. And I think over time we've been fortunate to get a reputation in the market that is demonstrating not only do we provide an attractive source of non-bank finance for companies that we lend to, but that's delivering a very good income and investment proposition for our clients. So it is something that is relatively unknown. I think people are rightly curious and want to understand what is the risks. People feel very confident in public markets. They feel very confident they're investing in the share market because they know what they're doing. But when you actually think about it,
and the TD is like motherhood. So,
but when you think about it, you're investing in equity, which is the highest risk part of the capital structure of a company, to benefit from the growth in earnings and growth in value of the company. You invest in debt to have equity wear the risk. So equity should be the absorber of the first risk of loss. And as a lender, if you're sensible and you've structured appropriate terms and conditions and you've taken security and you monitor and manage cash flow and you've thought about the ways in which you can exit, and you've got a skill set that can go back over many decades, and you can demonstrate that you've had experience in corporate restructuring and workout, and you've managed investor capital carefully, then I think you can demonstrate to people that it is actually a very attractive asset class.
And you're the first and most secure cab off the rank.
Yeah.
In the event of not such a good outcome.
Yeah, but importantly, for us, it's also very important that you provide investors with diversification. And so when we lend to a company, we want to be careful that we're not having a concentrated risk to any one individual borrower, because one of the ways in which you can mitigate risk for an investor is to have an appropriate sized position. So one of the things that has been of real benefit to our investors as Metrics has grown in size and scale is we've been able to add diversification. So if I think back to the Metrics Master Income Trust, when we launched that in October of 17, started with 55 individual loan assets that an investor gained exposure to. Today, in March, April of 2022, investors' exposure is diversified across close on 260 individual borrowers, and we've reduced the exposure each time. So as we've raised capital, we've enhanced the liquidity, we've lowered the cost, we've further diversified the portfolio.
Andrew, thanks for talking to us today.
Thanks, Peter.